This is the Phelan and Myers 2 for 20 with the Willett, Phelan, Myers and Roth's Wealth Management Group of Janney Montgomery Scott. Janney, a member of FINRA, SIPC, and the New York Stock Exchange, maintains a presence in Duluth with their office at 6340 Sugarloaf Parkway, Suite 130, Duluth, Georgia.
Good morning and welcome to Phelan and Myers 2 for 20. We're here today with Mike Dowdle. He spent 20 years as an entrepreneur in the Atlanta area, and he's the founding partner of a venture capital firm called Circadian Ventures based here in Atlanta. Mike, welcome this morning.
Appreciate it, Scott.
Thank you for being here. So tell me a little bit about your background. Tell me a little bit about your entrepreneurial history.
Yeah, I started my first company in 1995. About 14% of the U.S. was online at the time, and I started an interactive agency just building websites and sold that a couple years later to a private equity-backed consulting firm that we took public in 99. I formed our corporate venture group at that time. That's kind of how I cut my teeth on the venture world. And then I started another company, an e-commerce company with a partner in 2003 that we built up. We got up to about $85 million in sales, and we sold it to a Fortune 500 company in 2014. And then started doing some syndicate investing where I passed the hat on some deals for a couple of years. And then I formed Circadian Ventures, our funds, started that in 2000.
Okay. So, again, thank you for being here. And really what I want to do today is, I guess for purposes of this discussion, let's assume maybe I'm a tech startup, whatever type of technology. I want, for my clients to have an understanding of how it works in terms of lending, where does a tech startup go to find money, until they evolve to the point maybe where they go to a bank. And then once you built that company to a certain level, then what's the exit strategy? Like, who are the buyers? There's a lot of talk about private equity out there. There's a lot of talk about angel investors.
Sure.
There's a lot of talk about venture capital. But I don't know that everybody understands what that terminology is.
Sure, yeah. It's changed quite a bit in the last 20 years. 20 years ago, you had to buy servers and computer equipment, and you had to spend like $1 million just to get going out of the gates to set something up. Today, with cloud services and open source software, you can start these, especially software businesses, at very low cost. So what most people do is they bootstrap it. They either fund it themselves, they raise some friends and family money. They kind of just raise a couple $100,000 just to kind of get things going and get what's called an MVP, a minimal viable product, something that a customer can look at and say, yeah, I think I'd pay for something like that. And that sort of gets them out of the gate. But these mostly software companies, again, they're creating something that has great efficiency, high gross margin. They don't necessarily need a ton of capital. So what usually happens is they do the friends and family, and then they'll go to maybe some angel investors, raise maybe a couple $100,000 from
define
angels.
Angel investor, if you would, for me.
Yeah, there's a group of people that are out there that look for startups to invest in, that take a slice of their net worth and they'll invest in startups. And in Atlanta, there's different angel groups that are out there. There's Atlanta Technology Angels, there's Thai Angels. So there's a couple different groups that you can go to, and they'll pool money together and maybe invest $500,000 into a company, and it's smaller checks from a bunch of individuals. What's good about that is that you're not taking a huge amount of capital and diluting yourself. You're taking just a amount of capital to kind of build the product further along, get some customers and get some revenue and get some traction.
So I start Scott Phelan software company doing whatever type of technology I do, and I bring an angel investor in.
Right.
What am I having to give them in terms of ownership of the company? How does that work?
Yeah. Great question. So typically what we will see is that anytime you do a fundraising round, you can assume you're going to give up about 20% of your company.
Okay.
But what often happens in these angel rounds is there's not enough information to kind of put a value on the company. So what oftentimes they'll do is do a convertible note. We'll lend you the money and then we'll convert that into equity at a later time when you raise a larger institutional round. And the investor, for doing that convertible note, will get an interest rate on there and then also get a discount on what that round ultimately is. So there's convertible notes, There's a newer concept called a SAFE, which is a simple agreement for future equity. Very founder friendly, not so investor friendly. I don't encourage them, but that's basically a handshake agreement that yes, we will convert this into equity at a future date at a discount to whatever that future round is.
So you loan, in that example, you loan me $500,000. I pay you, pick a number, 10% interest on it.
Correct.
And then that $500,000 will convert from effectively a loan into stock in the company some point down the road.
That's right. Okay. So in the future, let's say they raise money at a $10 million valuation, and you've got a 20% discount. Your equity is going to convert at an $8 million valuation. So you're getting a discount into what the next investor is investing at.
Okay. I got you. So outside of bootstrapping at friends and family, then the next level is angel investor. And then once you get past angel investing, you evolve into what? What's next? Venture capital?
Like a seed. Yeah, you kind of go into the venture capital route. So we look at the angel round, and the friends and family is kind of a pre-seed round, meaning the company is kind of pre-revenue, might be even pre-product, just an idea, or just have maybe one or two customers. But then as you move further along, you get more customers, you have more revenue. We are a seed stage investor. Our companies, when we're investing, are doing anywhere from $500,000 to like $1.5 million of revenue. So they're still very early, still figuring things out. Their finances are on QuickBooks, not very sophisticated. The CEO is leading all the sales. They've got the product, it's in market, it's generating revenue, but it's really not taking off yet. That's where our sweet spot is, because we can go talk to those customers and kind of model out how many more customers will want that product. And the initial customers love the product and they can't imagine doing business without that product. That's really that seed round that we like. And, 15, 20 years ago, that was called the Series A round, like the first institutional round of capital. But kind of everything has moved up as these funds have gotten larger and larger. So that seed round is now the new Series A round. And that's where we like to come in. And usually that's the first institutional round of funding. There's still some angels that can come in at the seed round, but that's usually where there's a professional investor that will come in.
And so what do you look for in a company? You walk in the door of XYZ technology company. I mean, are there certain things?
Absolutely.
I mean, I got to imagine.
Yeah, we have a very clear investment thesis. And number one, we are only investing in experienced entrepreneurs, people that have done this before. And one of the primary reasons is we're a very small team. There's just two of us that are full-time doing this. And so we don't have the resources to do the sort of mentoring that needs to happen on a first-time entrepreneur. And there's tons of incubators and accelerators and angel investors out there that will do that mentoring. We just don't have the resources to do that. Plus, when I look back historically, deals that I was in that kind of didn't go well and friends that invested in deals that didn't go well, it's usually because the entrepreneur couldn't adjust to the market, adapt to the customers, what they were telling them, couldn't raise capital, and it was really kind of an inexperienced sort of thing. So number one, experienced entrepreneurs. Number two, we're only investing after there's revenue already coming in, because the risk factor of going from zero revenue to just $100,000 of revenue, there's a huge risk mitigation in that. So we're investing when there's already some revenue so that we can go talk to those customers and really dig in under the hood to find out why those customers love that product and why they need it. So I'd say those are the two primary things. And then the third is, we're truly at the seed stage. So we're not chasing these crazy valuations that you're hearing out there. On our first fund, the median pre-money valuation was $14 million. So very early on, young companies. We're very keen on the governance. So we're on the board of most of these companies. Where we're not on the board, we're very comfortable with who is on the board representing our share class. And then finally, structure. We make sure that these are structured in a very efficient way, and from a tax perspective, it's set up the right way so that future investors will be able to very easily come into the company.
So if you take a look at, Warren Buffett, for example, one of the greatest investors, obviously, of all time, he'll go in and take a majority stake in a company.
Correct.
But he'll keep the same owners involved. They basically run the company. He just takes a majority stake, so he controls it, but he lets them have the run of the place. Do most venture capital firms go in and take a majority or a minority stake in the company?
Right. So venture capital is like one sleeve of the larger private equity bucket. And so the larger private equity firms, they will take majority stakes in companies. At the venture capital level, you're looking to have a portfolio of many companies where you're having relatively small minority positions in these companies and making several investments. And our Fund 1 portfolio is a $17.1 million fund. We have 13 investments in that fund. But you say, well, what kind of protections do you have if you're a minority shareholder? Well, we have preferred shares. So we have rights to follow-on investment. If the company raises money at a lower share price where we came in, we'll get more shares in the company. We have the right to approve a sale of the company or liquidation of the company. We approve the annual budget, so we have say in the salaries. So we do have quite a bit of protections in how the company is run and operated. We're on the board of directors, so we do have a lot of say of what goes on, even though we have a minority position. And we get paid first before the common shareholders do as a preferred shareholder.
Okay. So angel investing, venture capital, do these companies go to traditional banks to get lending? I mean, it seems like there's a whole other lending market
Correct.
out there that has sprung up, I think, from 08, 09.
Yeah, traditional banks have a hard time getting their arms around these companies that are, sometimes have 12 months of capital and they're high risk deals. And so there is a whole cohort of private credit companies that are out there and banks that focus in this area that do lend out to these companies. And they'll do it in a combination of ways. They like to see equity come in. So investors come in, say investors put $2 million into a company, then a lender may come in with $500,000 or $1 million of a line of credit to go on top of that. And the company can use that as kind of a rainy day fund. When that equity runs out, they can tap into that. There's also, revenue financing where, these are SaaS businesses, highly predictable revenue streams. And so lenders will lend out to that, and then you just pay them back on a monthly basis out of that revenue stream.
Okay. So traditional banks are kind of the last
Correct.
place that these companies go
That's correct.
to get money. Okay. So I built Scott Phelan software company.
Congratulations.
Yes, it's a fantastic business. You should invest in it. And now I'm ready to sell. Okay, so I guess take a step back. So what's the typical holding period for a venture capital company? Like how long do you normally invest before there's an exit strategy for the company?
Yeah, most venture capital firms, their investments, the fund life is usually 7 to 10 years. We'd like to hold for at least 5 years.
Okay.
And the reason 5 years is that this stock is all qualified small business stock, which means that the IRS has created this, the government has created this incentive where there's no capital gains tax paid on the profits on these investments if you hold them for at least 5 years. So we like a minimum of 5 years, and then we want to hold till the maximum value is on these companies, and that can happen when the company may sell to a strategic buyer, they may sell to a private equity firm, they may go public. The IPO route, that's usually the longest route, but there's a very good payday potentially when these companies will go public.
Okay, so I built this company into $500 million of revenue annually,
Yeah.
right? And I say, you know what? I'm getting a little bit older. I'm ready to retire. What are my options at that point? And how involved are you in the sale as one of the venture capital firms?
Yeah. So that's usually a board decision of what the options are. In that case, there's typically going to be an investment bank that gets involved, and you'll look at options of going public, and you'll look at private equity, and you'll look at strategic buyers. Strategic buyers can many times pay the highest price because they can take that company and add it to their own distribution and their sales force and exponentially grow revenue. So they look at that as, we can buy it at a price that we can, quadruple the value of that asset over the next couple of years. So that quite often is your highest payday, but there's pluses and minuses of everything. The IPO route can be a massive win, but there's lockup periods and you're at the whims of the market. So there's puts and takes with each one of those options. But usually an investment bank gets involved and you're looking at a strategic buyer, private equity buyer, or a public.
Strategic buyer being somebody maybe that's another technology company,
Correct.
and there's some synergies when they come in and they buy you, or there's perceived synergies.
Correct.
Anyway.
You look at Cisco; they've been one of the most active buyers of companies in the last couple of years, and they're just buying up synergistic businesses to their own company, their own distribution, their own infrastructure.
Okay. So let's talk briefly about private equity, because it seems like that's where a lot of the money is being made when companies are being sold right now. I mean, it seems like every time I talk to somebody and their company's been sold, private equity is the one buying it. So how does that work? Like, again, I've hired an investment banker. I'm doing $500 million a year in revenue. We go out to, or the investment banker goes out to the market, and then private equity firms come in and
the investment bank puts a book out there, and they've got the relationships with the private equity firms, and the private equity firms show an indication of interest, and they'll do calls with management. They'll go into the data room, and eventually they'll get into the due diligence and put an LOI together. So they're bidding on that asset, and then it's just a negotiation from there. Is this all cash? Is it cash in stock? And what's the price? And the relationship with that business. And so there's a lot of things that get involved in that.
And private equity, to define what private equity is. Private equity is high net worth investors putting money together and going out and buying businesses.
Well, typically in the tech world, these are very large funds, $500 million, multi-billion-dollar funds. So think of large endowments, large foundations that they can't put $5 million. They're a $4 billion endowment. Putting $5 million into a small venture fund just doesn't move the needle for them. So they're looking for places to park $50, $100 million at a time. And so private equity firms that are managing the billions of dollars is a good place for them to park that money. And then those private equity firms are buying out these companies. And 70% of all LP money in the last year went to funds that are $500 million plus. So this market has matured to a point where these funds have just ballooned up to $500 million, multi-billion dollar funds, which makes this market super attractive for me because I'm a seed stage investor. So there's very few other investors that are investing at this seed stage because these funds have just gotten so big. And the people that were writing $1 million checks like my fund does, that were writing those 5 years ago, now they're writing $3 million growth equity checks. So the stage that comes after me.
Yeah. Yeah. And is that because some of the numbers that I hear some of these companies selling at is just crazy. Is that the reason? Because there's so much private equity money out there?
They're
and
getting
it has
bid
to go
up.
somewhere.
Absolutely. They're getting bid up. And, in the last couple of years, money's been flowing pretty freely. Now, the last, 2 years, it's tightened up quite a bit with interest rates going up and that lack of liquidity in the market. LPs are now looking to say, hey, we're not going to invest more money until we get some of these returns
some return back. Yeah. Okay. And in private equity, when they come in, they normally take a majority stake in the company,
That's right?
Okay.
That's right. Usually, but not always the case, but usually.
And then the owner will stay on generally for 2-3 years and get some type of earn out over time.
So usually the existing investors, when private equity comes in, the existing investors may sell everything. They may sell part of their ownership, and management will typically have a choice. They can sell some, they can roll all of it forward and not sell any, but usually there's an incentive for management to stay on. Usually it's for several years to continue the business and keep it growing, but those are all part of those negotiations.
I got you. Mike, that was awesome. Thank you.
All right.
Like I say, I wanted to kind of walk everybody through, because you hear all these terms out there in the market. I wanted to have everyone to have an understanding of what's venture capital, what's angel investing, what's private equity, how do these businesses evolve, how did they get money, et cetera. So you did a fantastic job. I really appreciate you being here.
Appreciate it. Thank you, Scott.
The information provided here is taken from sources which we believe to be reliable, but the accuracy and completeness of such information is not guaranteed by us. This is not an offer to sell or a solicitation of an offer to buy any securities. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Employees of Janney Montgomery Scott, LLC, or its affiliates may at times release written or oral commentary, technical analysis, or trading strategies that differ from the opinions expressed here. Investing may involve market risk, including possible loss of principal. Janney Montgomery Scott, LLC, its affiliates, and its employees are not in the business of providing tax, regulatory, accounting, or legal advice. Any tax-related statements are not intended for and cannot be used or relied upon by any such taxpayer for the purpose of avoiding tax penalties. Any such taxpayer should seek advice based on the taxpayer's particular circumstances from an independent tax advisor. For more information about Janney, please see Janney's Relationship Summary Form CRS on www.janney.com/CRS, which details all material facts about the scope and terms of our relationship with you and any potential conflicts of interest.